All right, today we're cracking open a real puzzle, DuPont. Now, if you just glance at their 2025 financials, they look, well, messy. Honestly, they're confusing. But underneath all that noise, a massive transformation is happening.
That's so true. It's like DuPont is building a completely new, much leaner innovation engine from the ground up. The big question for us is, what does that engine actually look like? And, is it powerful enough to really drive the company forward? So let's start putting the pieces together.
So, when you look at this company right now, what do you see? Is it this old industrial giant just kind of struggling under the weight of its own history, all these legal troubles? Or is it more like a phoenix rising from the ashes of this huge corporate restructuring?
Well, that's the thing. The financial reports can point you in either direction, which is exactly why we need to dig deeper than just the headline numbers.
And to get that full picture, we're going to look at this through two different lenses. So I'll be taking the analyst's view. We're going to dig into the hard numbers, the spin-offs, the profit margins, and really get into the balance sheet.
And I'll be putting on our generalist hat. I want to ask what this all really means for the products we actually rely on every single day. Things like life-saving medical devices and even clean water.
So here's how we'll break it down. We've got 6 key sections. We're going to untangle the company's very recent past, peek inside its new core businesses, check its financial vital signs, map out the road ahead, and then we'll wrap it all up with a final verdict on this newly transformed company.
First up, the great corporate cleanup.
Yeah, and let's be super clear about this. To understand the DuPont of today, you absolutely have to understand what it's not anymore. This has been a multi-year journey of just radical simplification.
And this timeline really shows the scale of that cleanup. I mean, look at this. It started back in 2019 with Dow and Corteva, and since then, DuPont has just systematically shed major parts of its empire. The most recent and really significant move was just this year, in 2025, spinning off its entire electronics division into a new company they're calling Qnity.
And with the aramids business, think Kevlar, also expected to go, this is pretty much a total overhaul.
Okay, so this massive cleanup creates a really key accounting term that you have to understand: discontinued operations. Basically, all those businesses you just saw on the timeline, their financial results get stripped out of the main reports and are listed completely separately.
And this is the crucial point, right? This is exactly why looking at DuPont's main profit and loss numbers can be so incredibly misleading. They just don't reflect the core ongoing business.
So, what was the immediate payoff from all this selling? Well, that Qnity spinoff alone handed DuPont a massive cash infusion. We're talking $4.1 billion. That is a huge number. But the real question is, what on earth did they do with all that cash? And here is the answer. They immediately took almost all of it, a cool $4 billion, and used it to pay down high-interest debt. Now, this is a classic deleveraging move, but it isn't just a number on a page. This is the company literally buying itself financial breathing room for the next decade.
So that was step 1 in building the new DuPont, cleaning up the balance sheet. Make sense?
Okay, so now that we've cleared away all the old parts, let's take a look at what's actually left.
Exactly. Let's go inside the new innovation engine, which is now focused on just 2 core, very high-margin segments.
And the first one, which you could argue is the most important, is healthcare and water technologies. This is not about commodity chemicals anymore, not at all. We're talking about highly specialized, mission-critical materials. So think about the sterile packaging that protects a life-saving medical implant, or the advanced filtration membranes that give an entire city clean drinking water. These are really high-value, highly regulated markets. Now, what's really fascinating here is the profitability. Just look at that operating EBITDA margin for healthcare and water. 30.1%.
Okay, hold on. For those of us who aren't analysts, what does that number actually mean in plain English?
It's a key measure of a company's core operational profitability, before you factor in interest, taxes, and some other accounting stuff. And let me tell you, over 30% is an incredibly powerful number. This is the new engine. It's leaner, it's way more focused, and it's highly, highly profitable. Okay, so with this new engine in place, it is time for a financial health check. Let's stress test the numbers of this restructured company and see how stable it really is. So if we run a standard DuPont analysis, which is a way of breaking down return on equity, the final number for 2025 looks alarmingly low at just 0.70%, which sounds awful. It would be, but remember those discontinued operations we talked about? This number is heavily, heavily skewed by massive one-off costs tied to all those spin-offs. So this isn't a reflection of the core business's health, it's really just the financial echo of the transformation itself.
A much better way to measure its stability is something called the current ratio. This looks at a company's ability to cover its short-term debts. And here, the story is crystal clear. The ratio has jumped from a pretty tight 1.17 to a much, much healthier 1.87. This shows that even though the income statement looks messy, the underlying company is actually on much more stable footing.
Okay, so the company is leaner, it's financially more stable, so let's look at the path forward. What does the roadmap for 2026 actually look like?
And just as important, what are the major risks that could completely throw it off course?
Well, according to DuPont's own guidance, the plan for 2026 is pretty simple. Lean into its strengths. They expect to see continued growth from their high-margin healthcare and water businesses.
Right, and they're also kind of banking on a stabilization of the U.S. construction market to help out the industrial side of things. They're forecasting modest but steady growth overall.
But it's not all going to be smooth sailing. The company is facing some really significant headwinds. The biggest one by far is the legal overhang from PFAS chemicals. We're talking about over 11,000 personal injury cases still pending. That is a massive number.
And here's a risk that might surprise you, a lingering connection to the very volatile semiconductor industry. So even though they spun off Qnity, they still have these intellectual property agreements in place, which kind of keeps them tethered to that market's ups and downs.
This quote from our own research summary really frames the central debate perfectly. We know the healthcare and water segment is an absolute star performer.
So the big question for 2026 really is, can the more cyclical industrial business bounce back as its markets recover? Can it provide that second cylinder for the new engine?
All right, we've taken apart the old DuPont, we have inspected the new one. Now it's time to put it all back together and come to a final verdict. So, after all of this analysis, we get to the ultimate question for any investor looking at this new DuPont. Is it a buy, a hold, or a sell?
You know, when you lay it all out like this, the case is compellingly complex. The strengths are really clear. You have powerful, iconic brands and a deep patent portfolio in some really high-growth markets. But the weakness is, those massive PFAS legal liabilities, they're just as significant. The opportunities for growth are definitely real, but so are the threats from litigation and, of course, economic cycles.
But look at this. This is where management is placing its bets. Their capital allocation, what they're doing with their money, tells a story of real confidence. After that huge debt repayment, their next priorities are a $2 billion share buyback authorization and nearly $600 million in dividends.
Wow. Yeah, that's a really clear signal that they believe in the future cash flow of this new, leaner company.
So in the end, we're kind of back where we started, but with a much, much clearer picture. DuPont has successfully pulled off a massive, and I'm sure painful, transformation. It has built a new, more powerful, and way more profitable engine that's focused on these high-growth markets.
But that powerful new engine is still attached to a chassis that's carrying all the weight of its past. And so the fundamental question for DuPont's future is actually pretty simple. Can this new engine finally outrun its history?